I think we're going to get started. Good morning, everyone. Thank you so much for being here. I'm Lenora Suki. I'm the head of product strategy for sustainable finance at Bloomberg. And I want to welcome you all to Bloomberg and to the Accelerating Innovation in ESG Investing conference. Before we get started, I think we all woke up to some really horrific news yesterday about the attack in Orlando, and I think that given that we're all here to try to advance a sustainable and inclusive society, I would like to ask everyone to take just a moment of silence to recognize the victims of the attack yesterday. Thanks. I also want to thank our partners in this event. So the Intentional Endowments Network, Tony Cortese is here, and he's going to give some welcome comments as well. I also want to thank Sonal Mahida, who is everywhere all the time, getting things done and making things happen. And to thank also Andreas Hopner from the ICMA Center at the Henley Business School at the University of Reading for all his contributions to the program, not just today, but in past programs as well. So just to give you all a bit of background as a word of welcome, and to put this all in context, my mandate at Bloomberg is to help build product so that our clients can use our data, our analytics, our research, news, and media products to gain a comprehensive understanding of the risks and opportunities that are associated with sustainability and sustainable investing. And what we're trying to do is develop our products so that any client can execute a sustainable, responsible, and impact investment strategy using Bloomberg products and services across asset classes. And, whether at Bloomberg or elsewhere, as many of you may know, this is right now still challenging to do. There are a number of different gaps, one of which is the kind of information that is reported. The second of which is the link between valuation and ESG analysis. And the third of which is execution. So products, opportunities, is there a real opportunity here? These are the gaps that we're dealing with here every day, and that I know that many of you are dealing with in your practices as well. And that's part of why we're here at this conference. The challenge of innovation in this space is something that the quantitative finance world has been addressing for a long time through academic and industry collaborations. And these academic industry collaborations have launched many a fund, many a strategy, many a consultancy, but that conversation is really in early innings in the sustainable finance and investing space. So this is the third conference we're doing to try to advance this idea that academia can help generate really useful insights for industry. So, we've tried to organize this so that every panel has a combination of academic and industry insights. And this year we've sort of decided to switch it up a little bit. In the first 2 years, we've approached this a little bit more from the perspective of quant strategies and data science and deriving scientific alpha. This year, what we've done is sort of mix it up a little bit more, and we are going to start the day with Andreas Hopner, who's going to talk about his quant data science magic. And I think for those of you who've never seen Andreas speak, you are really going to enjoy it. And then we're going to move on through the day and talk about data frameworks and other asset classes. So we're going to talk about financial innovation and new product platforms, infrastructure, and we're going to talk a little bit about human capital data. So I think it's a really interesting mix of frontier thinking in sustainable investing, and I hope y'all will enjoy it. We do have one change on the schedule, and that is that unfortunately Jeff Trukenbrod couldn't join us today. So instead, Curtis Ravenel, my boss, who is the global head of sustainable business and finance at Bloomberg, is going to give an update on the task force on climate related financial disclosures, which he is chairing. Which Mike Bloomberg is chairing, and which Curtis is running the secretariat with Mary Shapiro. So he's gonna give a presentation and an update on that, and I think SASB maybe as well, and then he's gonna sit down and have a conversation with Sonal Mahida about disclosure in the space and what that means for the future of sustainable investing. And finally, I just want to say, please join us for the reception, because Sonal is going to be launching Basic. Sonal is going to be launching Basic, which is a network of sustainable investing professionals in New York. We're really excited to be a part of that as well. So I hope that y'all will stay to help us celebrate the launch of Basic as well. And with that, thank you very much for being here, and I hope you enjoy the day. And Tony is going to give you some words of welcome as well.
Good morning, all. My name is Tony Cortese, and with my partner George Steyer and Sonal Mahida, we are the leaders of the Intentional Endowments Network. Let me give you a little bit of background about why we're here and why we're doing this. I spent the first 17 years of my professional career working in government, starting with EPA when it was formed in 1970. And one of the things that I learned, that while we were doing all these wonderful things to try to protect the environment, that we were making great progress, but we are still on an unhealthy, inequitable, and unsustainable path on a worldwide basis. And I decided that there was something wrong about the way I was educated, that I couldn't help people see things differently. And so I decided to go back to higher education to figure out how we could transform the way in which colleges and universities teach and operate and invest, so that the net result would be people coming out knowing how to make and do the things we need in society that would lead to strong, thriving communities and everybody having a decent quality of life now and in the future. And we did that for quite a while. George joined me about 10 years ago. You can see across campuses across the United States, the amount of stuff that's amount of things that are going on with respect to how to practice sustainability on campuses is enormous and incredible. The educational pieces that are going on, specifically for specialists, is terrific. But fundamentally, we haven't changed the way in which economists are trained or engineers are trained. I'm an engineer. We haven't fundamentally changed the way they're doing things. And we also had a major step forward 10 years ago now, where we asked a bunch of college and university presidents to put a stake in the ground and say that they would try to become carbon neutral in their operations as a demonstration to the rest of society. We started with 12 presidents with a publicly transparent and accountable commitment, and today there are over 700 colleges that are around 700 colleges that have made that commitment. However, with all of that work, there was a lead wall between the endowments and everything else the schools were doing. And then the fossil fuel divestment movement hit, and many of the schools were left not knowing what to do. Many of them hid behind ideas like modern portfolio management theory and said, we can't take away any fossil fuels in principle, et cetera. And so Jonathan Lash, who is formerly the president of the World Resources Institute and is now the president of Hampshire College, called me up and said, George and Tony, can you help me with helping schools to understand how to deal with these issues? And that is the genesis of the Intentional Endowments Network. We are a network of institutions. We're a network of investment managers, of consultants, and all of the people that are trying to move endowments in a sustainable direction. Our goal, we called it the Intentional Endowments Network simply because we wanted people to be intentional about getting the financial rate of return, but also by doing it by you by also trying to achieve their environmental, social, and governance goals. In my opinion, we will be successful when we don't have impact investing or ESG or anything else. There will only be good investing, because the goal is to move capital formation in a direction in which we used all the benefits of the private sector and the market sector to actually create strong benefits for everybody in society. Right now, we're just assuming and hoping that the market forces will lead to a thriving civil society, and it's not working. So what we are trying to do is to figure out ways that we can help people do that. And our goal is to work with and through organizations like Bloomberg, like PRI, like Ceres, that was our fiscal sponsor when we first got started, to create synergy and scale. How can we get everybody working together to create the synergy and scale? And this conference today is really important. We're honored to be part of this. I know you've been doing this, Andreas and Lenora, in the last couple of years with Sonal when she was at PRI. It's terrific. We can't see being able to move things forward unless we're accelerating the amount of research and the innovation that we're trying to do here. So I thank you very much for coming and attending. And by the way, I hope we can get the music back on, because I love these chairs. When I first sat down and there was some rock music going on, they swivel very nicely. So enjoy yourselves. Thank you very much.
Thank you, Tony, and thank you, Lenora. My name is George Dyer. As Tony mentioned, I help to coordinate and lead the Intentional Endowments Network with Tony and Sonal, and we're very pleased to be partnering on this event. And now it is my distinct pleasure to introduce our first speaker and our collaborator in pulling this event together, Andreas Hoppner. He's Associate Professor of Finance at the ICMA Center at the Henley Business School at the University of Reading. His full bio is in your package, so I won't go into the details, but as you can see there, he is doing some of the best and most exciting research in this space, advising many groups in the space to help build the knowledge base across the board, and we're in for a real treat. So, Andreas, thank you.
Welcome, everybody. It's my pleasure to be here. I would like to start with a few questions, because it might be in my memory, but from last year I can't recognize that many faces. So who has been here at the equivalent event last year? That's great news, actually. Then for you to come back, but also great news that there's so many new people. So, and who has a finance degree? About 30%. All right. Okay. So we'll show these slides then with a lot of conceptual explanation. I will talk about data science, as Lenora said, but I'll also talk about reasoning. And I will, and I'm very happy to be challenged by everybody with a finance degree, I will criticize financial economics once in a while quite heavily, because in my view, it's too theoretical and it's too less data-driven. So let me briefly describe to you what a financial data science perspective is. My affiliations aren't of that much interest, I guess. Financial data science is a combination between asset management, between maths and stats, and between computer science. So if I'm in finance at the moment in an academic finance department with a sector of my own, and maybe 2 or 3 others, then I can either work with economics, I can work with business, or I can work with psychology, which is called behavioral finance, but there aren't that many relationships yet with computer science. And Columbia has a pretty strong financial engineering degree, a couple of others as well, but we work very closely with computer science. In our case, it's a German Center for Artificial Intelligence, the biggest artificial intelligence research lab in Europe, and so we bring those things together. And when you work with computer science as a financial research, so the first thing is you get very, very jealous, because in computer science, everything has to be perfect, otherwise the software doesn't run. So you can have your Turing Award winner, kind of the Nobel Prize in computer science, doing a massive media launch, clicking the button, everything's black. Everybody knows it's wrong. That won't be the case for a financial Nobel laureate, and that won't be the case for me too. So please do challenge me. It might be that there's mistakes. I can certainly learn from you. And so finance is invisible, and that is a challenge. Also, data science, or big data, is a big buzzword nowadays, and let me put that in a bit of perspective. So when we launched the Financial Data Science Association in November in Zurich, David Avakia, one of the big data scientists at BlackRock, basically said data is the new oil and financial data science is new exploration. You'll have heard similar things from other people. But then let's also briefly explain, oh, that gets very loud, briefly explain what we are doing here. So essentially, there are data points. Data points is everything. The distribution in which you sit in the room tells me where the door is. It's on the back right because there's the biggest density of people sitting. So data point can also be pictures and can be text. Anything is a data point. And there is loads of them with big data, enormous amounts of data points. Then we have information, which essentially is data points in relation to each other. Andre sits on that particular chair. I'm standing here. Chris sits there. That's information. Knowledge we would consider is fact-checked information. So something that actually seems to be accurate and right. And then the last thing you're looking for is signals, but signals are very hard to get by. There's very few signals. They have an enormous value add, but you have to get very accurate to have signals. An example of a signal that most of us will be using is Amazon. You go online and you get a signal. People that shop like you like these things. And quite often it's relatively accurate, or if some friend used your account, then you realize what they were searching for because there's some new offers up there from Amazon that can on occasions be funny. So we then see that in relation of essentially the industrial revolutions before. So you started in Britain with the factories, then Ford put in mass production. In 1947, most people overlooked that the transistor came up, and that was effectively the start of digitalization, which we still have. And with digitalization, everything was recorded, so now you have big data, and it's just a logical next step to do data science, in our case financial data science, to analyze the big data, to support decision making. Very important, not to replace humans. Computers are only efficient, they're not effective. They don't really know what to do, and everybody, if you see it on TV where someone says a computer can find the question, well, the computer can find the question in a very, very narrow space, right? AlphaGo is great at playing Go, it's not great at anything else. So in that sense, it's very important. The human is the effective, the computer makes it efficient, and that allows us to actually do research at a much bigger scale. So we can effectively, for instance, test every individual indicator instead of having to ex ante pick which indicators we find great, and that allows us to find quite a few more inefficiencies that we would otherwise have found. So then, what are these inefficiencies in markets, and what actually leads to an outperformance in markets if markets are 100% efficient? Let me directly say, is it okay if I speak like this for everybody? No? All right, so I'll use the mic. Okay, so using the mic will just mean I need to click with my left hand, but essentially, the very simple notion of market efficiency is that you have a market like the S&P 500 and it's efficient or not, black or white. So practically speaking, that's very unlikely that things are black or white. There are shades of gray, 50 shades of gray or more. And essentially, that's the same thing with market efficiency. And it's also not only about the S&P 500, it is about all the other components. So we see market efficiency as a combination of what is the asset class you're looking at, say the S&P 500, what's the information set you're using, say corporate financial accounts, what is the algorithm, the search technology you're using to find your signal, say DCF models or CFRI, and then effectively, lastly, what's your time frame, say quarterly observation intervals on a 5-year investment horizon. So in the example I made, how many competitors would you have? Probably about 1 million. There's 326,000 Bloomberg terminals in full mode, equivalent for Reuters, maybe a little less, and then there's FactSet and so forth. So if you're doing a very straightforward example on the left side as a market segment, you will have loads and loads of competitors. And so if you have loads and loads of competitors, how likely is it that you beat the market? Not very likely. It's the same as poker. The poker professionals will tell you, if you really want to make money, you need to be a top player going to the tables where the poorest players with the most money is sitting. You don't have to go play the best players because they are just too good for you to make a lot of money. So if you then switch and you say, okay, we're using MSCI emerging markets, we're using, I don't know if that comes through, we're using 10-year monthly intervals, but we use, say, repris data, and then we use the 3-level card model. Suddenly, your actual number of competitors goes down to maybe 2 or 3. So essentially, one of the beauties of using non-financial data is that you're reducing the number of competitors massively. So what you really would like to find potentially is, A, which are the right algorithms to work with non-financial data. Is a bit difficult on the DCF because the DCF requires a monetization, it requires a quantitative money value. So maybe it's different algorithms. And then B, which data sets are there that are commercially relevant but actually overlooked by the rest. And at that point, we're actually talking about sustainable investing. And so What we are doing next in a conceptual slide is nothing else than combining market efficiency with Porter's 5 forces. Who's familiar with Porter's 5 forces? Probably, yeah, about everybody. The good question is why that hasn't been done before, I can't tell you. But for us, it actually becomes a very simple 2x2 matrix. We showed that to Bobby Lamy when he was head of education at the CFA. You'll see why he did agree with that. So the x-axis is the investor attention towards an information set, simply how many people are looking at this piece of information. The y-axis is the commercial relevance, and the CFI zone is on the upper right. So this is commercially relevant information that everybody looks at, which means to actually get an edge, you have to be very, very deep, high-pitched algorithm and so forth. So the real opportunity goes to the upper left, is the commercially relevant information that the other ones are overlooking. And then, Bloomberg can tell you better than me, but then if you look at the user statistics of the ESG data, it's probably not going to be as high as for corporate financial accounts. Yes?
I'm writing badly. Are we going to get slides?
Yeah, you're very welcome to have the slides. And there's another 400 slides that I can also distribute if you have questions. So this is only the starting 60. I have a deck of about 800, and about 400 would have been relevant, I guess. So the investment opportunity arrow, I'll take that one and put it on the y-axis now. And so the best opportunities are actually where the entry barriers, the complexity is highest. And that's the paradox of ESG, which is, especially in the US, it has been for years and still is, a big convincing case with a lot of investment committees, because politically some people just don't think ESG and financial markets fit, but that is your best entry barrier. If your competition actually has a superstition against using it, you don't even have to put up some legal entry barrier or some complicated algorithm nobody else can do. They're just not going to do it. They kind of disqualify themselves, which is a great entry barrier if you found useful information with ESG indicators. And so we think that ESG is one of the best things to do in terms of financial materiality, because it's new information. It is relevant in many industries, not always every industry, obviously. And if you use the right algorithms, you can find some nice outperformance opportunities, as I will show you later. However, there's also challenges. So I'll close with one case on impact, where the impact data is something that we will need to work on altogether, we would argue. So the first thing is a very easy example of what was found. This is a study from 2007. Statman and Gluskov from from Santa Clara did a very similar study afterwards. And this is KLD data, which is like the simplest data. It's the 1 for a positive thing, -1 for a concern. It's a long history, and they're studying in the US universe, do you outperform? And at that point in time, between 1991 and 2003, I asked Steve Leidenberg how many people would use your data, and he believes it was 0. He says there were loads of them that bought it, but purely for PR reasons, but actually using it, Steve says maybe 1. So that would explain why Kempf and Osthoff and Statman and Gluskov find it's very simple outperformances, that you use the strengths and the concerns, and you outperform 6.22% per year. That's 622 basis points on average in best-in-class community. Diversity best-in-class, 430. The great charts, ignore them. They are not significant. But so you had a very nice outperformance opportunity between 1991 and 2003, which then guys from Maastricht show that goes away in 2004, 2005 is gone then. So at that point, people used the data too much. The simple kind of ESG 101 outperformance opportunity was gone. You had to be a bit more advanced, and people were more advanced in situations. So the interesting thing here is this is equities, right? This is equities in the US. And I regret it, but we're researchers. Sometimes it doesn't go that quick. I was hoping to have the fixed income equivalent ready. I'll probably have it ready for the autumn season. But we're having very interesting results using the same data going 20 years back in the US with fixed income universes, because they're actually, ESG is even more relevant, since ESG is a great risk indicator. And fixed income securities basically trade on risk perceptions. If you buy something that the market thinks riskier than it actually is, great for you. If you sell it the other way around, it works as well. So I'll give you more examples of contextual ESG alpha, because the alpha we're finding now is not, it performs always, it performs in certain situations. And I'll start with one where we were looking at the women on the board, and we formed portfolios of companies that had more than a third women on the board, companies that had no women on the board, and companies in between. And we did it for 26 countries at that point classified by FTSE as developed. And we found that globally speaking, value-weighted portfolios did outperform with more women on the board at a general level. That looked quite good, that had a bit to do with industries, but it looked good for the women on the board. And that was driven by the US. So companies in the US with women on the board, and directly for the non-US women, that has nothing to do with the nationality of the woman, it has to do with the company, it actually performed quite well. But we also found 2 countries out of the 26 developed countries classified in 2012, where no women on the board outperformed. Anybody wants to guess? No, China wasn't classified as developed at that point. No. Italy and Greece. And so, if you're thinking about the type of women that Silvio Berlusconi would have promoted in politics at that point, you start to see where the differences between data science and financial economics, because we assume, like anyone else, that the board will have competent women. Apparently, in Italy and Greece, there's at least the possibility that some chairs of the board appoint women for different reasons. So, in that sense, Italy and Greece was the one where we did find the actual underperformances. Then we looked at carbon emissions in Europe. And that's a topic I'll come back to later in the presentation, because it's very close to my heart. So, when you have 2 environmental managers, conceptually speaking, in a similar company, one BMW, one Mercedes, for instance, and one of them is working real hard to collect all the carbon emissions from all the factories, and the other one isn't working that hard, both of them report the number that they collected, and they both have footnotes. One of them says this is 99.9%, the other one says this is 83% of the emissions. Then the vast majority of data systems, with the exception of Bloomberg, will just pull that in, and the one with the lower emissions will look like more energy friendly, because people don't really adjust for the actual percentage of disclosure, which is a huge problem. So that means, and that our results, and that's not surprising, when you look at the actual emissions in the carbon sensitive industries, having high emissions leads to an underperformance, but having low emissions doesn't lead to an outperformance, because the most analysts can't distinguish between what is actually genuinely low and what's just fraudulent, poor reporting. I mean, there's no legal standard, so what's just unfortunate reporting. Let's put it that way, with the British part of my personality. When you then actually look at reporting quality does outperform in the carbon sensitive industries. And if you then go to the carbon insensitive industries, and these results, they keep popping up, and by now we think they're genuine. Initially they were very puzzling. So you take an industry where carbon doesn't matter, and the companies that simply report perform better. And significantly better, and you do a robustness check. And it doesn't make any sense, because this was supposed to be your placebo control group where there was supposed to be nothing there. And then when you keep getting these results, you're thinking of a model that the Japanese developed, which is the Kano model. Processes in a company. You have processes that they must work, otherwise company goes bust. Then you have processes which are kind of more is better processes. Then you have nice to have processes, which are kind of gimmicks. They're nice, they make you look better, but you don't really need them. And that would be carbon reporting in a carbon insensitive industry. But of course, if you have many of them, and you remove them, or you put them up, it might actually tell you something about how much time the top management has. And so we think that these little indicators, individually uninteresting, but as a consensus, they basically tell us, is the top management firefighting? Are they having to cut resources? Because if you have to cut, the first thing you want to cut in a financial service is your carbon report, because you really didn't need it, right? So in that sense, there is a big connection between ESG indicators and quality of management if you see them at consensus level. If you take a range of ESG indicators, especially the ones that you don't really necessarily need, if they're removed, it's an early signal in our view the company is having to firefight, going into trouble. If they edit, it seems the company has a lot of time. You might still argue it's maybe not the best way to spend their cash, but it's certainly kind of the company has time to think about all sorts of details. So that's what we find on that side. But the by far strongest thing in the laboratory on ESG is risk. And that makes sense, because when a company manages their ESG aspects, what's the board going to do? In many ways, they're trying to constrain the downside. They're not really, some companies have opportunities on the upside, but the other ones are trying to look good, but they're really trying to constrain the downside. They don't want reputation scandals, they don't want oil spills, and so forth. So it's all about risk. And the beauty with a financial data science laboratory is the speed. Keep in mind the computers make it efficient. So when I just use my finance team, we can run 2,000, 3,000, 4,000 regressions in a month. When I work with a computer scientist in a joint laboratory, we run 1 million in less than 5 days. And that is, we build the portfolio, we assess the portfolio, and we interpret it. And that gives you a speed that was unprecedented, certainly for us, and actually allows us to literally, every time we now analyze data sets, We analyze data sets, not the indicators we think are most successful, which in the past we would have always done because it would be too time consuming to actually integrate all the indicators in the analysis. And so this is an example data set from IRIS. I'll switch data set to GMI in a second, but here you have the ratings from IRIS. We form a simple portfolio. We update it once a year. It's like a very simple index. And all we want to test here is what are the risk implications of forming these portfolios, having in mind that IRIS is pretty strict. So the exceptional rating, the best rating, normally has a lower number of firms in the actual portfolio. And so let me show you, if you form the portfolios and you simply run a standard deviation, that's coming aside, then you actually get a relatively moderate outcome. And there is 2 slides we should probably discuss before that. So before going into the straight portfolios, it's also important to keep in mind how the asset management industry looks at the moment. You have a benchmark, you have a tilted benchmark, then you have something that's called smart beta, it's kind of the hybrid between active and passive. Then you have strategic beta, adding on strategies, dynamic beta that brings in a bit of financial data science. Then you have the dynamic alpha, which is your quant fund, the classic stock pick alpha, which is essentially the classic way, and then you have scientific active equity. Anybody heard of that? Anybody from BlackRock in the room? So it's a term that BlackRock uses to effectively describe entering a financial data science type laboratory into the process. So on the marketing slides, they would have satellite pictures counting the car parks in front of retail stores to get an early idea about what the density is. They would use Google search indexes to predict retail sales, and they have some pretty impressive slides showing that the best indication how much retail sales is there is not the academic index by Michigan, it's not general economic indicators, is how much people search for buying cars. Because compared to other searches, if you search for luxury goods, they're going to buy it anyway, the rich guys. If you search for white goods, people are going to replace. But people only start searching for cars if they think they have enough money to actually take on the extra. So certainly from the slides that BlackRock shows, and we find similar things, car sales is a pretty useful indication. And so you then get different assessments for these types of strategies. So the indexes are assessed on tracking error, which is effectively, are you matching or missing the index? The smart beta is assessed on information ratio, which is like your outperformance divided by your tracking error. And the active ones are assessed on alpha. And in the quant fund, it needs to be at least 30 stocks. In the classic and the scientific, it can be just 1 stock. And you can really pick literally individual stocks. And I'll come to in a second to that, why that is important. So take the tracking error, okay? It's an error of tracking the index. If you had a 30% outperformance, like a fantastic fund, 3,000 basis points outperformance, and you had a 4% tracking error budget, you wouldn't be allowed to do your outperformance because you would miss the index too far upside. Does that make sense? Would any investor mind? Would they say, oh my God, we missed the index on the upside. We really have to watch out. No, they wouldn't. Why are we using a tracking error? Why are we not using a trailing error? It's the same thing, just only for the downside. The reason is we're not really reflecting. We're reflecting on the sustainability very, very well, but we're not reflecting on what we actually call risk. A kid on the street will tell you that the risk is the probability of a negative event. The chance that someone steals money from you, not the chance that someone gives you money. Finance textbooks, all of them, have one problem. They're also very commercially motivated. They were written in the 70s and 80s when, for simplicity reasons, people put in a standard deviation. Semi-standard deviation, the downside, has been developed in 1959 by Markowitz, the same guy that developed portfolio theory. And he admitted in his own Nobel speech in 1990 that semi-variance would be better than variance because that's what people call risk. It's there on paper. But then the finance textbooks, they were written describing the 60s and 70s, and then instead of writing them new, they were just updated. Like, another 10 pages and it's a new number. Another 20 pages, a new number. So most of what's in the finance textbooks still describes a market that effectively doesn't exist anymore. There is no ETFs, ETPs, smart betas. There's nothing like that in there. So that's, I think, why we follow on the risk side. And keep that risk thing in mind when we're going forward. So I said companies are trying to manage ESG risk, and research shows very actively that there is lower cost of debt, there's lower credit ratings. ESG indicators are really good indications of risk, and Godfrey, Merrill, and Hansen show something quite nice. If the US SEC investigates against a company, those with a high ESG reputation are penalized less in the first investigation than those with a low reputation. Somehow there is an insurance like goodwill cushion. And then moving from this comes the question, how do we actually bring this together, and why do we ignore it before? So the reason we ignored it before is because the textbooks also tell us that this firm-specific risk doesn't matter because we diversified away. There's this very nice graph that everybody with a finance degree will have learned. The problem is, that's great for us as a business school, because whenever you teach that slide, the students look like, wow, this is why I'm paying my fees, that's really clever. But actually, it's practically not correct. Practically speaking, there is 3 types of risk. There is your diversifiable firm-specific risk, which is the variance term and the variance covariance matrix, so those are familiar with it. There is your non-diversifiable firm-specific risk, which is the standard deviation terms in the covariance. There's 2 standard deviation terms in every covariance. And there's your systematic risk, which is your correlation in the covariance. There's 1 correlation term in every covariance. So basically, the covariance has 2/3 non-diversifiable firm-specific risk, and you're stuck with it no matter what you do. But because we wanted to sell our textbooks and our classes, we kind of explain you that component is very small, and that's just statistically very, very wrong. I'll show you that right now. So we are taking IRIS data, 1,800 firms, FTSE All-World developed, and then we plot them out. So if it was only about number of firms, the portfolio was the smallest number of firms, like here the 99 exceptional in blue, that would have a much higher risk. It does do it for the 99, but it doesn't do it for the 75 or for other situations. So it's not only about the number of firms, because the number of firms are getting irrelevant when you get into the 50s, 60s. They get less and less irrelevant, and after 300, they're really pretty much out. So also keep in mind, this is standard deviation. So that's the deviation to the upside and the downside, and certainly equity markets are chronically negatively skewed. That has to do with our human emotions being chronically negatively skewed. We build trust very slowly, and we run away in fear. And that makes a lot of sense. It's a very animalistic instinct, and that keeps happening over and over. Let me show you the downside of this. So now I take semi-standard deviation. It's the same thing, just looking at the downside. And the blue charts are actually, on average, better, although they have a lower number of firms. Now I take extreme downside risk, which is basically an exponent of 3 instead of 2, and the blue charts get even better. And now with the simplest measure of risk that I ever could present to asset owners, which is the worst case risk, just the worst monthly outcome, that is the worst case risk. 200 basis points difference in all the cases for the simple environmental indicators that this provider has. So that means 2% saved in 1 month in the financial crisis. That is a lot of money. And now you will say, well, this is just the environmental indicator. Let me show you the social. I only show the downside because I don't consider volatility or variability risk or deviation. So on the downside, you can see it's the same kind of message, but it's a different story. It's not about being the best. It's avoiding to be the worst, right? We're human beings. We're allowing people to be a little bit naughty. You just don't want to be the naughtiest kid in the class. And when we look at extreme downside risk, it's the same picture. And we look at worst case risk, you don't want to be the 2 naughtiest kids in the class. In the kind of crisis situation, it is a bit hard an assessment. And then, and these slides are, I think, new for anybody. I've never shown them in North America before. Let me show you governance. So on a financial data science approach, we now take governance data. This is GMI data, now MSCI. And we're going through all indicators. So this is 40 different indicators on the screen. There is more. It's the same slides as before. Effectively, this is a semi-standard deviation. The good ones are the blue ones. The gray ones are the bad ones. You can see for most indicators, the bad ones take a higher risk. Not all of these portfolios will be useful practically because of diversification issues, because there might be negative alpha associated, but quite a few of them will be useful. And then we take these indicators very practically and we build an index, in this case an index out of 10. And we compare the thresholds of the index. So the midline is the 80% threshold, and that on average gets 25 basis points per year. And actually this universe of about 4,200 stocks is pretty much split even there. And with 2,100, you're doing quite well. And then comes an additional aspect of ESG data that's very beautiful. Most of the current min vol strategies, the most popular form of smart beta, of course, does the following. It measures the volatility, if they advance the downside volatility, and then decides when a stock is min vol and puts in a portfolio. If you had data as a signal that would show you when a stock is going to become min vol instead of being it yet, you can actually front run them. A very simple approach. So we here want to try to manage risk, but if we take the last 2 years of this sample and actually build an index, that happens. So that's a pretty good strategy, which was unexpected, not intended in any way. We just wanted to manage the risk side. But because we happen to front run the low vol strategy, which is a lot of money put in terms of flows, actually the low risk are doing well. And I will close with one question that I don't answer confidently myself nowadays, because it hasn't been talked about with academics generally. So we always talk about arbitraging away the upside. Like you find an alpha, it arbitrages away. But what would happen if I had stocks that had a lower risk and I would tell other institutional investors? First of all, they start buying it. That's obviously a good thing because they cause demand for the stocks that I just bought before. But then, since they're institutional investors, if I tell the right institutional investors, the more long-term ones, they're unlikely to sell it quick. So it might make it even safer. So there is no evidence at all to suggest that on the risk side, things arbitrage away the same way as on the return side. And that becomes very interesting when you then see the concept. Equities is upside and downside. And I like to encourage you to think about equities as an upper partial moment of the distribution and a lower partial moment of the distribution. That's really what statistically happens. Fixed income is just downside. And relating these things yields a lot of wonderful signals that can be used, and I suspect, although I don't know for sure, are used by some of the multi-asset teams in like the AGIs of this world. So let's come to the fixed income side, closing on the equity with a thought, would risk advantages actually arbitrage away? So on the fixed income side, we have the laboratory. It has just not got ready for this event, so we'll have to show the results in September, but they're very interesting. They go along the lines of no news is good news, generally speaking, in fixed income, seems to build trust and confidence. But we did have the ability to study all existing SRI fixed income funds. So we're trying to understand which ones are outperforming. On the equity side, there's proxies of expertise that is normally come back to the actual house, like which house is bigger, which house has more expertise. On the fixed income side, we use a lot of proxies. So we define anything, financial data science, that is reasonable. We look at the size, which is an expertise proxy for equities, the percentage of ESG assets in the firm. We look at the positive screens, the negative screens, the total screens, and we look at engagement as well. And we see if that makes any performance different. The charts I'm going to show you is as before. If they're gray, disregard them. They might be large or small, but statistically they're not very meaningful. And so we then run a fixed income model. This is an advanced model of Elton and Gruber, basically, where we put in some currencies. We tend to explain more than 90% of the variations. So we're pretty confident about our results. And these are the first results, all gray. So when we take the actual indicators that are used for equity, which is like the firm size or the kind of percentage of ESG in the firm, we don't find any meaningful results. When we look at the actual positive screens, we get a bit. So the very high screening ones in fixed income seem to do better, and the very low screening ones seem to do worse, but it's not a very strong result. This is nothing that we would actually rest a conclusion on. When we look at negative screens, it's different. It's more in the middle. So there seems to be something about screens, but the data you have on screens on funds is very poor. I mean, people can just write 3 more screens and we might misclassify them. So we need to get to another proxy for expertise. And when we look at engagement policy, that resonates. And that leads to 2 interesting questions. Is engagement for a fixed income security sensible? How much is it actually happening? Or is engagement just a proxy for the size of the team and the budget, because engagement teams are more expensive than writing 5 screens on your fact sheet? And what would happen? And actually, Stephen encouraged me, and I'll say this now on stage, so you don't have to ask the question anyway, see there, to actually talk about fossil fuel divestment also here for 1 second, because while fossil fuel divestment in the equity space competes with engagement a lot, and when you divest, someone else necessarily has to buy, because the company sold the shares way back then, debt denial is what actually brought the South African regime down, right? In South Africa, it wasn't the equity divestments, it was the debt denial. It was Chase Manhattan and other banks saying, we're not renewing your loans. This is very simple for an asset owner, because all you have to do is not renew. You don't even have to sell the debt you're currently subscribing to. And it is the one that really, really hurts the companies, right? If you talk with investor relation teams over beers and you ask them, what are you guys focused on? They're at least as much focused on the fixed income than on the equity, usually more. The equity side is great for their bosses' bonuses, but has nothing to do with the company itself. The fixed income side, not getting your debt renewed, is a disaster. And any investor, even the smallest endowment, on an undersubscribed debt issue would make the cost higher for the company, because anyone else wouldn't be willing to complete it at the rate. So debt denial might be a very interesting thing, links a bit to the engagement topic here. But the beautiful thing with data science is we can look a bit deeper. So we can look, what type of engagement is it actually? And engagement policy is actually worse results than the overall engagement. So we're not really sure that the policy itself makes such of a difference. And then private dialogue via public. And the private dialogue really seems to make a difference. Public dialogue doesn't make a difference for the fund's collective action, neither. Looking a step deeper, we are then coming to litigation action, exit strategy, or engagement. And here we find litigation action, those funds that really go the long way seem to perform best. They seem to accumulate most expertise about the riskiness of the securities. And finally, we can go and actually look at the topics. And that's quite interesting. Governance scores quite high. Environment doesn't. That normally happens when you have all industries together. Environment is good in specific industries, but relatively meaningless in others. Social performs well, but politically sensitive areas, so engaging for Sudan, Iran, or something, actually underperforms. The asset manager seems at that point to take the role of the state, which doesn't seem to actually work. Yeah.
Do you look at the public-private engagement issue for equities, whether or not public or private engagement?
We haven't actually done that. That's a good point. We are academics. We're also a bit on a competition issue, so no one else looked at this on fixed income. The last big equity study was by Renneborg and colleagues in 2009. We're just doing another one, preparing another one now, so we'll put it in there. But there wasn't a case for us because the last big study was too recent and too well done. So we actually focused on the fixed income fund. So I don't think anybody has done that yet on equities. We have done a lot of research on engagement working with Hermes Equity Ownership Services. That's all private. That works very well. It's heavily risk reducing. But that's not comparing it with public. So we can't really say compare it with public. Some shareholder activism certainly works. We can say that for evidence. But that kind of comparison for funds we haven't done yet. Finally, before going to questions, I like to come to an impact measure, because I understand there's also lots of people concerned for impact, and particularly climate change. And I don't think Dick is in the room yet, but he's a very good person to speak about it because he has a lot of expertise on this particular topic. It's also very close to my heart, to be absolutely honest, because it is a challenge. It's a big problem, and it highlights why independent events like this, that are done by people with a passion, not with big budgets, and not funded, especially with corporate budgets, make such a difference, in my view. So when you look at the greenhouse gas reporting standards, and keep in mind how big greenhouse gas is, I mean, there's 10 organizations now discussing it, plus the task force. So there's lots of people discussing, and we have pretty good idea of scope 1 and 2, at least we believe so. The greenhouse gas equivalent type is certainly prevalent nowadays, but then what we call reporting boundary here isn't really looked at. And it's in about every report. CDP is doing that heavily with the disclosure percentages. Bloomberg has a very good indicator percentage of disclosure in the terminal. Not many people look at it. And if you look at these definitions, GRI is a bit fluffy there. Activities with significant sustainability impact under the reporting boundary chosen. That kind of gives a company discretion to only pick the ones they like to show. The other ones are relatively strict, but it's not tested. And the interesting thing here is that the sustainability campaigners have an ally, which are the lawyers. The lawyers are very uncomfortable putting numbers out without a footnote saying this is not 100%, because they're worried about getting sued about it. So even in Europe, where it's not like the US, where your legal system works certainly better than ours overall in suing companies, but even in Europe, they all have footnotes. So we went with a study that we published last year in like this pretty good top 3 journal in the field of accounting or social accounting. We went and collected all the data manually from 2005 to 2009, all the footnotes. The worst footnote we found was a footnote saying this is equivalent to 35.7% of our emissions scaled by sales. So you can imagine if that actually comes into the overall data set, unqualified, then the quants will get confused. Right? And we never found particularly good strategy with the actual emission data, so we of course dig deeper and deeper into the numbers. And so if you look here, we have 23% that we qualify as complete in 2009 in our European sample, where there is a EU ETS and there's a price for carbon. And complete, we called more than 90%. That wasn't 100% or anything, that was more than 90%. There still is a substantial difference. And now I would like to show you some examples, which I normally don't do, but some examples how that actually looks in practice of better companies. I'm not showing you companies that are necessarily all-time lows in carbon, One of them got pretty low, but the other ones are reasonably good. And this is before the scandal of Volkswagen. So let me start with British Airways. This is the appendix of British Airways. And data science is not only a big laboratory, it's also a lot of detail work, a lot of manual work where the computers can't read it yet. And the appendix of British Airways has a very nice statement, which is organizational boundary, operational control. British Airways accounts for 100% of emissions from operations that we or one of our subsidiaries control. That is exactly what you want to read. Nothing fluffy, nothing that indicates that something has been put on the carpet. A straightforward number. And that's 2013, because 2014, 2015, even British Airways gets a little less accurate on the numbers. And one of my other jobs on the affiliation is I'm on the technical advisory committee of CDP and work with Ian on the data. And I can tell you, ironically, airlines are actually great industries to do statistics because they can measure it very well. And there's a very, very clear link to revenue. Airlines is about the best industry to estimate missing carbon data, while diversified industrials is the worst because that isn't an industry. That's like the rest move together in many situations and is so many different types of structures. Let me show you Volkswagen, and that's before the scandal. So Volkswagen has these numbers, and if you look at the numbers, you see that the charts differ a little bit. So, looking more precise, Volkswagen has CO2 emissions scope 1 and 2, then there is a footnote to that one, says group production sites. Okay, group production sites, what's a non-group production site? That will be the first question. And then if you look at it further, the other divisions, sometimes they're reported, sometimes they're not reported. So, that also makes it a little bit funny. And that's a company that afterwards ended in a scandal. Let me show you another company that actually makes money, to my knowledge, with renewable energy, General Electric. So they have moved from reports to online reporting, which is a bit more difficult for fact-checking, nicer for marketing, but more difficult for fact-checking. And if you look at their footnotes, they say, for greenhouse gas and energy-related metrics, each year GE adjusts its 2004 baseline inventory to account for divestments and acquisitions. For 2011, 12, and 13, greenhouse gas and energy-related data were not collected for the new acquisitions. As a result, adjusted results are unavailable. So that doesn't tell you if they didn't adjust for divestments for the years that they didn't have the acquisition data, does it? It leaves it pretty open. And if that was the case, so you're accounting for the investments, but you're not accounting for the acquisitions, well, then of course you're biasing your numbers in a certain direction, and the numbers go still up. And so the question for the audience as a guest question is, now Bloomberg has this beautiful field, which is percentage of disclosure, and there's great work done in the background checking the companies, and one company is even classified as 99.9%. In the most recent financial year, so that's depending on the company, either 14 or 15, how many companies have 100% disclosure of carbon globally? Anybody want to guess? No, and it's better than none. 5? No. 15? 22. 22 companies, these 22 companies, a pretty random mix, have 100% score on that indicator. There are companies with 99.9, there are companies with 99, but there's also a company with 12.5%. Right? And that's reworked from, they say it's only emissions. I think this is a Japanese company that says it's only emissions for Japan, only 12.5% of the revenue comes from Japan. So here you can see it's something, it's like Aviva as you would expect. I mean, Steve Waggart is very much known for doing great work in the space, but then it's also Chunghwa Telecom that I hadn't heard of before, or the Scottish Weir Group. It seems to depend on the actual people that work there that really want to have these emissions. And so with this kind of indicator, I would encourage people not only to discuss the high-level things about Scope 3 and all the other beautiful potential things, but the carbon footprints we're using at the moment, they're essentially quite insufficient, let's put it that way. So in essence, it's like an interest rate. You have a nominal carbon footprint, but it's not a real carbon footprint. And we're quite away from that, and we really have to work as an investor community with the companies, because any organization that's too much funded by the companies won't going to do this in the end, I can tell you that. Because every company that knows that 90% carbon emissions is what they're reporting, they could take the number in the report, divide it by 0.9, and they have a 100% number. No one is doing that. Right? No one is scaling up. Yeah.
And also can't have scope 3 in it otherwise.
No, this is not Scope 3. No.
So
Yeah.
financial institutions, it's not
Yeah, you get, for some of them it's much easier than for others, absolutely. But at least it's 22. number would get even further down, yeah. And we had a complete side note. Some of them report 0 on score 1, which is an interesting other component to that. But the main actual question is then, how do we get the companies there? I think engagement is great. I think fixed income engagement could be great. And I'm looking forward to hopefully having a bit of a discussion about the numbers. And I thank you, Diki, very much for providing that information. This is me with the presentation. Thank you very much.
I didn't hear a number for the social avoidance per year, the risk avoidance per year.
You gave 2%. Oh, sorry. So when you spoke about avoiding risk, you spoke about environmental avoidance of 2%.
Yeah, I didn't give a number. That's correct. I'll give you the number.
Points.
So here we're talking about, depending on how you classify it. So for stakeholder engagement, we're talking about 4% nearly. For the stakeholder policy, if you take the worst 2 versus the best 2, that would be even more, 5%. And for stakeholder systems, it would be more like 1%.
Thank you.
Oh, yeah, please. Looking forward to questions, and if you could introduce yourself, that would be great. Yeah, Stephen.
I just
You
realized
get a mic.
that I'm trained as a historian, and so are you. This is all
So?
data in the sense that it's past performance. The data are uncertain, we know that. Facts are in dispute, decisions urgent. What are you trying to tell us about what we do now for the next year, the next 2 years that comes out of these data? I'm in dialogue with Exxon, and it's very interesting, and we're talking about Plan B, and I think the issue for most of us as share owner engagement people is, what's the Plan B since Plan A isn't working?
Okay, I think there's 2 parts to the question. Yeah, so let me come to the Exxon part in a second, just answer the historical part. A question I very often get is, so what about the forward-looking aspect? Of course, any data science necessarily will have historical data, and you need to always differentiate between a forecast, essentially, and a foresight. A forecast is based on historical data, assuming that the data generation process, which is a human behavior, will be broadly the same, and then your results going forward will be quite similar to the results going backwards. In fact, your explanatory power, if you have 95% explanatory power, the chance that you'll be good going forward is very high. Here, this is an out of sample on the governance, so it actually shows that it works both on the risk side as well as on the return side. So this is showing that in a situation where the process of thinking stays the same, it works. However, if Greece, for instance, would go rock bottom bankrupt, the thinking of everybody over sovereign debt would change dramatically. So always, next to the forecast, you have to run a foresight, and the foresight we run in a sense that there's a signals from social media and markets. Our market's very, very nervous. And if the chance that the market completely breaks into a bubble is there, then the forecast should simply wait. Right? We need to stop and wait for more data, because then the forecast is not going to work. It's a new scenario nobody's ever seen, so it's actually non-predictable by its very nature. So on the timing thing of things, it's important to combine a forecast with a foresight exercise to say what's the chance that people thinking will continue. If people thinking and people trading continues, then the numbers will be good. If there's a drastic change, like a bomb in the New York Stock Exchange, then it might make a big difference. On the Exxon case, I believe, and I strongly believe that the engagement in equities is great, right? The whole thought about debt denial for me came from seeing Mark Campendale from Carbon Tracker debate with Bruce Duguid of Hermes EOS, engagement versus divestment, and they weren't even talking about asset classes. And Mark's done lots of great work, but he never considered fixed income to be a different thing than equities for whatever reason. And so then I went to talk to Donald McDonald, the chairman of the IGCC, and he very much appreciates the thought, saying, yeah, in fixed income, we should really deny further debt. That's a very simple process. That actually makes a big difference. And combining engagement with debt denial, maybe not for Exxon directly, but maybe for some of the smaller contractors in the chain, is actually potentially highly efficient, because that gets them into trouble. They will then either have to buy the smaller contractor, or the smaller contractor might not perform exactly that well. So I would encourage you to look at Exxon as a value chain rather than only the big thing, It's certainly not the weakest point in the value chain. There are weaker points. And basically the point in the value chain they rely on was the worst credit rating is the point to start, because that's where the reaction will be the strongest. That would be my view on that. Any other questions? Yeah.
Would you repeat the remark that you made about the SEC in the early part of your...
Oh, yeah, sure. There was a study that's not my study, it's from Godfrey, Merrill, and Hansen. They study what happens if, I'll go back to that, where here I think, they study what happens if the SEC investigates against the firm. In the first instance of the investigation, does reputation matter? And that's a bit like when you hear a rumor of a friend that's involved, for instance, in adultery. If the friend is a priest, you'll say, must be wrong. If the friend is having a known track record for maybe not doing adultery, but all sorts of other funny things, you say, well, possibly. And so in this case, they find quite strongly that you can basically defend your share price losses in the first instance by having a strong reputation. The market won't penalize you as strong as a company is known to be dodgy. So that was this particular study. It's pure US because it's SEC, but it gives you an insurance like goodwill cushion for reputation. Further questions? Well, there's this. Oh yeah, there's one.
Heidi Welsh, Sustainable Investments Institute. I was interested in your discussion of engagement. It's very hard to track private engagements, so I was just curious about. It's easy enough to track shareholder resolutions, but those are often the impact of those sometimes depends on who's asking and how many shareholders there are, and if it's TIA, CREF, or CalPERS versus a very small group of nuns or something. But private engagements, it's just really hard to track. And a lot of the really large institutional investors do private engagements, and they don't talk about them, but they potentially have a much bigger impact. So I was just curious about your data source and how you're coming up with your conclusions on that.
Yeah, so private engagements, it takes a lot of time for academics to get to the data because it takes an enormous amount of trust. So fortunately, we have that trust from Hermes Equity Ownership Services, and we have the whole data set, which is essentially their Salesforce system where they record all interactions. So we can see letters of a large bank coming back rather negative on Hermes engagement, and then we can read in a newspaper a year later that the dual CEOs have been ousted. So this kind of work we can actually see in the database, and then we code this. We code this in terms of what was the tone of the engagement, what was the frequency of meetings, what was the calls, meetings, who did they speak to, and then we basically build investment portfolios. If someone had invested, nobody did, at that point in time, based on these engagement strategies, would they have had lower risk and larger return? And we can then find that there is a significant enhancement return. But private engagements you can really only study with that data set, then with the Bank of Montreal data set, as Ari Dimson did, and possibly with the GS data set, and maybe with one or two other data sets. But you really have to have a couple of geeks inside the company that wrote down very, very decently for years what they exactly did. Otherwise, it becomes very difficult to study private engagements because without the records, we can't do much. So we see it has an impact. We have there's working papers out there or publications out there that show this impact, but to study it, we need hundreds of data points, and it's a lot of work. So that's the situation on the private engagements. But it's possible, and we see it has an impact. And so if it has an impact in the broad thing, if you're powerful enough, it will also have an impact for other individuals. At least we assume so. There is 10 more minutes. I'm looking at Lenora. Kurt's not here, right?
Is there anyone using this kind of... Sorry, this has been Bingham with Three Sisters Sustainable Management.
Yeah.
I'm asking whether there's any commercial entity that's using this kind of intelligence.
Is this kind of, what do you mean?
In terms of forecasting and
so the last one here, for instance, this is a project with a Swiss asset manager. So that would be a Swiss asset manager that runs this out of sample, has data scientists in-house. And so, yeah, people use it. I mean, BlackRock uses it in Scientific Active, and there's also people using it in sustainability space.
Okay.
Further questions?
Hi.
And please ask questions because we have another 10 minutes of time.
May I know how you address the synergy effect of different indicators? Like there are so many indicators you talked about, and how do you address the synergy effects in data science?
Yeah, so there is two answers to that. The first thing is we have a deep data delivery standard where we work together with 26 asset managers and another 9 academics to actually enhance the data quality and enhance two things. The actual integration of the data quality in terms of accuracy, because it otherwise takes a lot of time to load them into the system, and the integrity of the data quality in terms of taking, for instance, money from corporations. So we're doing something industry-wide to enhance the data before it comes to us. When it comes to us, we basically use statistical means of separating one data source from another one. There will be something called orthogonalization. You're essentially creating data streams that are uncorrelated. And so that is relatively easy to then separate all of the data streams from each other. The question then is kind of, where do you start? Like, do you separate an Ökom from a Sustainalytics so that the Ökom is full and the Sustainalytics is half, or other way around? So it is very possible to separate data streams from each other. It's a technical process, essentially, and that works quite well. If you look at the correlations between the data providers, they can be high, especially those which are relying a lot on corporate reporting. But in the data science process, it's straightforward. It's called orthogonalization, and I'm happy to provide more references in case of interest. Further questions? Yeah.
Tony Cortese. How do you get this information in the hands of people that can actually use it? In other words, Tony Cortese from the Intentional Endowments Network. How do we get this information in the hands of people that can utilize it in a way that they can understand it? There was a brilliant performance, but it was so rapid fire.
We write white papers. We could do webinars with the Intentional Endowments Network. We'd love to do this. I travel a lot. I don't think I could travel anymore given my health. So we try our best to communicate it and to make it simple to understand. And because I have some more time, and of course I want to stop on the exact time for Curtis to join. He's already here. Brilliant. And so I would like to show you, especially those that are non-millennials in the audience, 2 more slides. I do have appendixes in case people ask, I kind of drop into them. And I think this is very important when we're talking intentional endowments because all the students will be millennials. And anybody knows how a millennial is defined? A millennial is defined as someone that graduated from high school in 2000 or later. So it's your high school graduation year that defines you as a millennial. So you're joining the job market in the new millennium. That was made up in 1985 as a catchy term. It turned out to be a very big difference in thinking. And I tell you why. Because of a certain alphabet. So 1998 Google started. And if you graduated from high school, and that means you hit university in 2000, 2001, 2002, which I actually did. I hit university in 2002. You're going to get some very funny comments from your professor, which is, don't use Google, go to the library. Or that has Lycos or Yahoo or whatever. And if you go to the library, it takes ages. You go from A to Z, you write on your comments, and it's very inefficient. And if you go to Google, it works. And so, for the first time, you really don't trust your professor because they tell you go to the library, and everybody that diligently went to the library went to no party, and everyone on Google had everything ready. So Google outperformed the library big time, and that has led millennials to start distrusting classic approaches because Google works. And Google works different. The library works linear, A to that. Google works non-linear. And that makes you much more rapid. You want to answer questions quicker. You think you might be able, clever Googling, 20 minutes, you have the answer. And so these types of millennials didn't trust professors for the library, and they didn't trust professors for the Wikipedia either, because professors were like, don't look at Wikipedia, listen to me. Don't look at Wikipedia. Don't Google in my classes. Listen to me. Well, actually, you should Google in class. The professors are all right. So Wikipedia is maybe not a great reference because it doesn't have the best reputation, but the reference in Wikipedia are much quicker than any library. So the millennials are impatient, and they have the official allowance from asset owners in Europe, the representatives who are millennials, to say that they're equally impatient, just I have academic freedom, so I can say it, they can't say it loud. So they're impatient, they want to change things, and they are very much focused on the actual finance side, and they are now the biggest generation in the market. So if you think the decision makers are between 35 and 65, the millennials are just hitting that. And the more they become decision makers, the more it can make a difference. And they think differently. and they have a degree of impatience that is quite different from the previous generation, and they choose jobs differently as well. They work on what's actually cool, not necessarily on salary purely. And so I encourage you to think about the difference of how millennials work, especially with the internet, and especially with the non-linearity of searching for stuff rapidly rather than following a very linear process. It does make a big difference. And at that point, I say thank you very much. Hope it was fun. Looking forward to discussing the break. Thank you. Yeah. I think there are no further questions, but if there's any final question, of course, very happy to take them. Oh, there's one over there.
I have a suggestion. Why don't you all stand up and stretch? Because we're going to be sitting for another hour as soon as Curtis comes in.
City of New York Small Business Services.
Okay, can we reconvene? All you gentlemen in the front. Reconvene, please. So Andreas, when he when he was doing his introduction, said a data point was the distribution of where people sit. And one of the things I've noticed my entire life is nobody likes to sit up front. And I thought it was just because of student classes. Nobody wants to be in the front row. And then I discovered when we held a conference for about 75 college and university presidents, they did exactly the same thing. So I'm wondering sociologically what's going on here. At any rate, it's my pleasure to introduce Curtis Ravenel. Curtis doesn't need any introduction. He's been a positive troublemaker for a long time. But seriously, he is in charge of all the sustainability initiatives at Bloomberg, and it's a chair's set of initiatives. So and it's throughout everything they do. Working with their clients, they make sustainability a consideration in everything they're doing. And as you heard earlier, the FSB has established a climate disclosure project that they asked Michael Bloomberg to head up, which means Curtis is going to be doing the work, as we all know. But the important thing is that Bloomberg has been a really big force in legitimizing concerns about using ESG criteria in the way we make decisions about investing. And so we owe you a great debt of gratitude, Curtis, for all your work over the years, because it's making it possible for all of these things that we're trying to do now possible. So, Curtis, thank you.
Thank you. Thanks a lot. Actually, can I? Oh, I've got my. I didn't realize. I usually like to walk around with a mic, but I'll skip that. Let's make sure this thing works, right? Yeah. So, I don't know how much you spoke about it before. I apologize that I'm just getting here now. But this thing has consumed my life. And so I'm a little frantic with it. We have very tight deliverables. And something like 30 members of this task force who all, as you might not be surprised to know, have very strong opinions on the matter. And so trying to corral them all into sort of outcomes, actionable outcomes, is a bit of a challenge. But leave it up to this constituency of financial market players to come up with yet another sort of long and laborious name, right? The FSB Task Force on Climate-Related Financial Disclosures. You're like, great, that's a good elevator pitch. That's to like put them to sleep right away. But the story behind that name is actually pretty important. The FSB staff and Mark Carney's office, who is the Bank of England chair, but also the chair of the Financial Stability Board. Did you all go over what is the Financial Stability Board? Are you all familiar with this at all? Okay. So the Financial Stability Board is essentially the regulators and central bankers of the G20. It is ostensibly a G20 body, semi-independent, one of those sort of confusing things with just lots of dotted lines here and there. But they were created in the wake of the financial crisis to advise. They created something. The first thing they did was create another task force called the Enhanced Disclosure Task Force. And that task force was charged with figuring out what the financial system largely should disclose more of so that they could get some visibility into what potentially would be the next financial crisis. And it was, I think the difference between this task force and that one was it was one set of actors. It was the banks, essentially, right, who had to come up with, and they had real threat of legislation hanging over their head if they didn't come up with some voluntary disclosures. And in fact, many of their recommendations were, even though it was voluntary as well, industry-led, many of their recommendations were adopted by Dodd-Frank and in the UK and in Canada as well. And not all, but many. And that's formed the basis of this. So Mark Carney gave a really seminal speech September 29th to Lloyd's of London about the idea that climate risk had some characteristics that you could make an argument for concentrated some financial risk in the fact that many of the valuations, it's the stranded asset theory, which I think many of you know, but for those of you who don't know, is that these externalities, oil reserves, for example, may not be being priced properly because there's no way we could burn them all. If we burn everything, we burn ourselves up. And so the idea that these asset prices may be mispriced and that could face, in the light of Paris and technological innovation, really two big drivers, costs coming down considerably and the Paris Agreement being reached. And as prices come down, it gets a little bit easier, obviously, to implement those policies, that you could force a repricing that could reverberate throughout the financial system. And so he wanted to create a task force. As soon as we read that, Mary Shapiro and myself, and Mary's former head of the SEC, works for Bloomberg in a lot of different ways as a consultant. We went to see Mark Carney and talked about how we could help, and that's what led to Mike being the chair of it. And basically Mary and her team and me and my team doing most of the work on it, because Mike jokingly said, "I don't actually have to do anything, do I?" We said, "No, we'll take care of it. Please preside as you do so well, and make sure that you force the issue when it's needed," which he also does quite well. So, look, there are, and many of you know this, but some may not, there's a lot going on in this space. And it's a little bit of death by a thousand cuts, but at the same time, it's created a whirlwind. This fragmentation of activity is actually a driver, right, to create this, because people are, it kind of reminds me of, we're a global task force, but of course, many of us are based here, and I think about how, industry likes the federal government to step in sometimes when states run off and do their own thing, just to create some consistency. So we think that there is an opportunity, even though this is voluntary led, that industry could get behind us. And we have to take what I call a Goldilocks approach, which is, we can't be too far ahead or too far behind. We have to be a solution to a problem that exists not just for us in the financial community who want to be able to look at this information sort of across not only individual issuers and asset classes, but at a portfolio level, and of course the regulators would like to see it at a systems level. And so all of this activity is to our benefit and driving this process, right? This slide is really for people who aren't in our space, but I think many of us in the room recognize that climate risk has the potential to be significant. And WEF, who are no real tree huggers, the World Economic Forum, identified, and they do a 10-year projection on what are the biggest risks facing the world, and climate is at the top as far as likelihood and impact. These are mainstream people, right? I think that's the other key thing to note. I think the signaling between Mike Bloomberg, who despite all his climate cred, is still a very hardcore mainstream business guy, and Mark Carney, who is the probably most influential regulator alive today, are coming out and saying something that many of you in the room have been saying for a long time. This is a validation and mainstreaming, if you will, et cetera. So, and of course, it doesn't hurt that, as I know you're learning here today, if you didn't know already, that there's some pretty compelling evidence and from reputable firms, Mercer just being one of many, showing that there's going to be some price swings here, or that there's a good probability that there will be, some positive, by the way, and some negative, depending on the industry, geography, et cetera, right? So that evidence, coupled with this movement, again, creates an opportunity for us, right? I've sort of said this already, but the real background is that even amongst the G20, who are technically our constituency in this task force, you've got 16 out of 20 of these jurisdictions already have some form of reporting requirement. It's just not consistent, right? I think that, and this gets back to the name, which I kind of skipped over, which I'm prone to do on occasion, climate-related financial disclosures. I think the key thing that the FSB realized when they named that horrible name was what they were trying to show was that this was about, it's the economy, stupid, to use that old Bill Clinton adage. This is a financial risk. This is not it is a moral risk, it's a values risk, but it's a value risk as well. And they wanted to also to signal that we want this not in mainstream sustainability reports, but in financial filings. And that does two things. One, it creates despite Bloomberg's wild success in proliferation of its terminals and use as a financial analytical tool, it's a pretty expensive tool, and not everybody in the financial community has access to it, and therefore doesn't have access to this kind of information. And even we don't, because the information is not that great, as we all know. We want it in financial filings so that for the distribution reason, and number two, because it automatically will draw the attention of the boards and senior management of those entities, right? It creates a whole governance structure automatically without having to sort of, say it should be audited, it should be verified, it needs to be relevant and/or material, which I'll talk about that in a minute, another big issue. It just automatically, by asking for it to be in the financials, makes the board accountable. And that's super important, right? So the idea is to say, and this is Mary really came up with this sort of framework, which I think is right. You have a legal obligation, and actually she has the scars to prove it from when she issued her disclosure guidelines in 2010 from the SEC. And she was just really run over by that from opposition on what are you doing, why are you using the SEC to address a public issue that's much more about politics than anything else. But the reality is there's a legal obligation to disclose material information. And there's a lot of evidence that this is in fact material today. Pieces of it, right? We're not going to be able to figure all that out. And this is another sticking point that we can talk about more maybe during the Q&A, but there's this idea of what's relevant and what's material. Materiality has a very high threshold, and it's very important that that threshold be met for most of the disclosure. It's a much easier path. I think what we're seeing with climate is that we don't know yet what is material. That's part of the problem. You can't really figure out what's material until you look at all the information and aggregate it up. So one of the ways in which we're thinking about that is we're thinking about what's relevant, what we think may be relevant first in order to determine what is in fact material. And this is going to be, I'm sure, a very big point of discussion at our July plenary meeting. Right now, we don't have the ability to roll this stuff up, right? Everybody reports differently. There's little nuances. Now, of course, Bloomberg's made a fortune on asymmetric information. And so, in a way, we like that because then we come in, unpack it, make it consumable, comparable, as much as possible, standardized, normalized, etc. But this is too important and too big and too now to wait for that to happen on its own. I personally believe that all of this is an inevitability. We're just trying to be an accelerant, right? And regulators really do need some visibility into that systems risk, right? We, as financial professionals, want to be able to look at the issuer level, probably want to be able to look at the portfolio level. They want to look at the aggregated level. And that's a whole different challenge, right? And so making sure you have relevant and material and decision useful, as we like to say, information for the investment community may or may not always roll up to what regulators want, right? So, the idea is then to come up with sort of clear, efficient, voluntary framework, and that will ease the burden of both reporting and essentially using this information, right? That's all well and good. How do you do that? We already reported on what we call phase one, which is really a landscaping issue, right? Figure out what our scope of work would be, right? What kind of asset classes, are there thresholds, et cetera. Some of those, this was just us outlining how we were going to proceed, not us determining what exactly we were going to do. We wanted to get some public consultation in after our phase one report, which we did. We had well over 200 responses that were not a response to the phase one report, but really a response to how, based on the phase one report, should we refine our efforts and make sure that we come out with something decision useful. We are essentially going to be doing our final report in December 2016. Keep in mind, this is such a short timeline. For those of you familiar with SASB, which I think many of you are, Sustainability Accounting Standards Board, they took 4 years to do their work, and we're trying to do this in one. Now, of course, the idea is that we leverage the outstanding work that SASB's done, the Carbon Disclosure Project's done, IIRC, GRI, the alphabet soup of activity that we've seen over the years on this, and that we're really trying to sort of align those efforts a bit more on one specific issue, which is climate, which is the big one. We've got a huge, because we're G20, essentially the process was the FSB reached out to the G20 members and said, submit names for consideration to join this task force. It was vetted by them, given to us. It's a mixture of preparers and users is what the terms they use, basically issuers and financial participants. You've got very big names on there. You've got big industry, BHP Billiton, JP Morgan, BlackRock, and so the idea is to make sure you have a mix of the right people in the room, and these are senior level people who have some decision-making authority, where in a safe place where they can argue with one another. And this is why, much to many people's dismay, there were no NGOs included on this list. There was this concern that these folks would not be able to speak freely their mind, and I assure you they speak very freely all the time, and that we could really hammer something out then. That's not to say we're not engaged with all of those groups, because without them we wouldn't be where we are. They've really driven the ball up to here, and we're just trying to help bring it over. This is really a validation of all that work that's been done. It is, we meet 4 times. We've already met we met in London, we met in Singapore, we met in Washington, D.C., which we're missing from here for future deck remembers. We've got these work streams, right? We have the transparency bit is super important. We've got, for those of you in the room who have not been engaged so far, we really encourage you to become engaged. Just Google FSB Task Force on Climate Risk. You'll see it. You can sign up. You can become part of our working groups in different ways. We'll be reaching out to you all. We have got to get a lot of engagement in order for this to be successful. It's super important, right? And this is all the phase 1, which I just sort of talked about before, right? Now, what we did also was take what Mark Carney had 3 areas. He called it physical risk, liability risk, and transition risk. I think we more or less know the physical risk bit. I mean, we don't know, but we have an idea of what that means. And we really broke it down to an acute and chronic, and I always talk about water. Water is a chronic challenge. Extreme weather events is an acute one. And then we broke up some of the transition risk into these areas. And this was really a framework for us to begin thinking about, all right, where is this risk depending on where you are in that data and prepare matrix. And it's super important to also talk about the fact that there is opportunity, as was indicated on that earlier slide by Mercer. There are some asset classes and industries and geographies that will benefit from some of this. Now, some of these benefits might not be things that we necessarily think are great, like the fact that you can do shipping through the northern part of the planet now in a way that you couldn't before, but they have to be recognized. We also talk about how there are, and many of you in the room who use this data today know that we do try to capture when companies are taking advantage. This is Al Gore and David Blood's whole thesis, right? Generation Investment Management, that there's this transition to a low carbon economy, and there are firms that are well positioned to benefit from that. And those ones that have invested in that are going to be able to be more resilient and transition faster and easier once they have that capacity, right? And then, again, the roadmap for the rest of the work is really making sure that those concepts are well known within the different working groups, and so that each company or preparer and as well as user can try and get the information they want and need to do their analysis. At the very highest level, this is not, the idea is to not make a new process out of this, right? My dad has a saying that, the greatest force in the world, inertia. And he's right? I mean, you introduce something that is new and more, again, outside of this space, the pressure on boards today is really quite remarkable. And if you create a new process for them, it's not going to work. So you got to find a way to integrate this within the existing framework of how they look at risk management, strategy, governance, metrics, and milestones, targets, and what is the infrastructure under which they are able to manage these risks and opportunities. Really on the strategy side, it's more of the opportunities. On the risk side, more in the risk management bit. And so that is super important. We're very, very, very much looking at existing best practices around corporate governance writ large and fiduciary duty to move this into there. We're not saying a new process, we're just saying this is a new issue, and we're going to try to provide you guidance on how to think about that issue, right? It also, the metrics are going to be important. There's going to be a lot of fighting over that as well. How much of this, you can't have qualitative without quantitative. Same. You can't have quantitative without qualitative. We have a backward-looking bias in general in all kinds of accounting. And so the idea that we want to get some more forward-looking things in here is important. And the idea that it needs to be in a safe place within the financial disclosures so that these people, especially in the litigious U.S., these people don't get sued for forecasting things that don't happen is another big issue, right? We need to allow them to do scenario analysis around a possible future state that may match, for example, the NDCs established in Paris, nationally defined contributions, and how that might change their industry, and how if you have a certain market share within that industry, you should be thinking about what kind of carbon allowances you will be allocated in some form or another. Are you assuming there will be a price on carbon? Are you using an internal price? All of this will be in sort of technical guidance. But I think the one thing that really struck with me is there would be, I think, significant disappointment from Mike and Mark, and we really don't want that. I don't want that. If we weren't ambitious, right? But practical. We cannot just codify what exists today. That's not going to cut it, right? We have to be thinking more ambitiously about that. But at the same time, you don't want to be overly ambitious where you get 2 or 3 companies really doing a bang-up job of disclosing and nobody else doing anything because it's too hard. And so you've got to try to find this little Goldilocks again, right? And that goes for the regulators too. They don't, I always joke about the SEC, they don't want to be too far ahead or too far behind. And so the more you bring this into the mainstream, the more likely everybody asks us, why is this voluntary? This should be mandatory, et cetera. That is not our remit. It would have never been approved as a project from the FSB if it was intended to be regulatory. That's not to say that, just like with the Enhanced Disclosure Task Force, that regulatory bodies could come in after this, look at this framework, and decide that they wanted to make some of it mandatory. There's a lot of opinions on the task force that feel that that is the only way to really succeed. But that, again, is not our remit, all right? We decided, and I kind of hit on some of this, in the financial filings, critical. It is really, if you read carefully the remit, it says it's really targeted to financial participants. They're the ones that have to disclose. That's what the task force is intended to do. But of course, you can't have them disclose if the things they own aren't disclosing. So you have no choice but to go beyond financials and look at all sectors. And when you realize that, of course, and SASB figured this out early on, it's very sector specific. Climate risk and utilities is going to be very different than in healthcare, right? And then how do you get over this sort of bespokeness of what's done today and create something that gives a real view, right? And this bottom part I've alluded to several times, and I'll just make it again, is unless this is doable, it's not going to get done. So it's got to be clear. It's got to be really sort of targeted. You got to do the 80-20 rule. You can't do everything. It is amazing. People feel like this is the moment, and so people with their own agendas have really been trying to jam everything under the sun into the remit of what we're trying to do, and we constantly have to remind them that our scope is pretty specific, right? This is a timeline. I won't bother reading it. We'll make this available to all of you. But the really interesting part is what we realize is that the high version is we have a plenary meeting in mid-July. We want our what we call baseline recommendations, which really apply across the board to all sectors, to be more or less agreed to by that date. And then we'll spend the time between mid-July and mid-September when we meet in Paris refining the sector-specific stuff. So what I mentioned earlier, utilities and oil and gas are likely going to have much more sort of robust disclosure needs than, say, an industry that is less resource intensive, like healthcare or maybe even telecoms, which I kind of think sit in the middle. Then from Paris essentially to November, when we present to the task force, is when we write the thing. And you think, well, it's 2 months to write the thing. You would not believe how important the language becomes during that time. You think everybody's agreed on everything, and then you say it one way and people freak out. And we need to have the time to get the language right. And I think what's interesting is you got half of sort of climate, ESG, sustainability people, and then you have a lot of people that are just much more sort of boilerplate, economic, government regulator type writers. And together, we'll produce something that I hope is consumable to a broader audience, which means it will be kind of boring and dry to read, but hopefully effective and consumable. Not a lot of flair, not a lot of assuming. It's just important. The language is just so critical. The good thing about, we do have technically a little more time than end of December because we're going to get feedback from the actual FSB. You take that feedback, publish our report in December, and then there'll be another comment period for you all, everyone else, to participate with sort of a final, although I hope there won't be too many changes, in March of 2017. Now the reality is, by then, you may have missed the cycle for that year's reporting, right? You can't really, so you're not really going to get any participation, in my view, this is a personal opinion, until 2018, when people are doing 2017 reporting. And some of what we're proposing is likely to propose, sorry, I shouldn't say anything yet, is going to be complex and hard to do, like scenario analysis. I mean, we saw a presentation from BHP Billiton, who has done a public scenario analysis on their business, and it was a huge undertaking for them. Lots of variables, making sure that we have the technical guidance that these companies and investors need in order to understand what we're talking about is going to be very important. But I do hope that it is a way in which this larger universe of ESG and sustainability information, there'll be a lesson here. My dream was always that, hey, we're picking this one big topic that got the attention of these very senior, mainstream people, and we're going to learn a lot in this process that will be more broadly applicable, I think, to the ESG world writ large, and hopefully provide a pathway for us, right? I always get in trouble saying this, but this could be a gateway drug for the rest of it, right? You're going to figure it out, and it took forever. I love when SASB always reminds people that in 1934, the Securities Act, it was, people didn't disclose revenue before then because that was considered confidential business information. Can you imagine? So I think, in the end, we're going to be pressing up on that issue. What's confidential business information? But you always are. And finding that sweet spot is going to be a real challenge. Again, here's a little bit of information. We'll send this around so you all have it. But I'll stop there. And I don't remember if we are you and I having a discussion now, and then we're doing, and then we're going to do Q&A?
Yeah.
Okay.
Why don't we do it that way?
She's going to tee up some of the questions for us, I think. So, thank you.
Thanks for that, Curtis. It's always great to see that you can bring some lightheartedness to a very serious topic.
That's all I got.
Helps engage the audience. So a lot of us know a lot about SASB, and we've been following their work today. And now you're involved with SASB and TCFD. Can you clarify how these two initiatives intersect and their objectives and their differences, especially for an investor audience?
Yeah, so the simple way I explained it is that SASB is all sustainability-related information, ESG issues, and it's very focused, rightly so in my view, on U.S. capital markets. People forget that it's half the market, half the market is U.S. markets, and that there are many companies that are not domiciled in the U.S. but are listed on U.S. exchanges and have ADRs, et cetera. So SASB rightly focuses in, and I've always admired this about Jean. There's a clarity of purpose that she had. You get that one right, and the rest of the world will really follow. It will. So it's all ESG stuff, U.S. focused. The task force is just climate focused, but global. And so that's the simplest way that I explain the difference, but they very much feed into one another. I think one of our goals at the task force, and we've certainly been speaking with the various standing setting NGOs about this, is that we want our work to inform each other. I've alluded to this, and I'm probably getting ahead of myself, but it won't be the first time, is that we are likely to go, SASB rightly to be successful made their threshold of materiality quite high. You're never going to get acceptance in the US market if it's too low. And so it's very high, and so it's very targeted. We will we'll certainly consider whether the outcome happens or not is another matter, a broader set of information than what SASB has disclosed, because we're global, and because globally the threshold's a bit lower, especially in Europe. But that's okay, right? We want to inform one another on this issue. This is an iterative process, annoyingly so, if there ever was one, and it's important that we communicate together. And the good news is that a lot of the NGOs, SASB, CDP, CDSB, are coming together to say, how do we support this initiative, and how do we make it a success? Because they know, even if it's not everything that they want, that it's quite an important shot at doing it. So, we've learned a lot from SASB's process in this, in the sense that you've got to get consensus, essentially, right? But you also have to be ambitious. And you have to be strategic and tactical and thoughtful. And it's a real challenge. But I think together, those two things, I mean, there's a reason that Mike is chair of both of those things, right? They are about better information. He's got this great phrase I love so much. It's like, God we trust, everyone else bring data. And that's really in the end what this is about. I mean, data is the lifeblood of and I do think it's important to note that, yes, people are like, oh, this just seems like it benefits Bloomberg's business. You're goddamn right it does. It does, but it's a public good also, right? And that when you have a public good mixed with a private good, you have commitment, right? We're committed to this because it is a public good and a private good. It allows us to invest and be serious about it and bring our resources to bear. Without that, I think it'd be a lot harder. It also means that we're somewhat commercially minded about it. And if we're not, it's not going to be successful. It's got to be used by the markets, and that means it's got to have a commercial bent to it. And I think that that's super important. And so it's exciting and kind of a pain in the ass for me to be involved in both of them, because I just think it's about the market infrastructure, and Lenora talks about this a lot too. It is our infrastructure sucks right now. I think we all realize that. Sorry for my colloquialisms, but it's just not that good, and we need to make it better. And it's going to take big things like this to really drive it home.
I'm actually going to open up to the audience because I think you just put a lot of food for thought out there. So does anybody out there have any questions?
Yeah.
Oh, the mic's going to come to you. If you can just give it 1 second.
Paul Ellis from Paul Ellis Consulting. Curtis, the March review, it's close. There are close to 30 different reporting initiatives on a global basis. How is all of that information being digested by the people?
Oh God, there's a lot of reading. Let me point out that this is not just a few staffers, right? Promontory Financial Group is a consultancy that Bloomberg uses where Mary hangs her hat. There's like 7 people there. We've hired a bunch of people internally. The task force members themselves have activated their internal networks. We're talking about BlackRock and JP Morgan. These are not small institutions. So you've got a lot of people chunking this thing out, and I won't bore you with the details, but it's very painful. You've got essentially different groups. We have now 4 work streams, really, which one is around governance and really how you integrate the stuff I talked about earlier. The other is around financials. And financials is difficult, too, because, remember, they're preparers and users, right? They have to report, but we also need to know what they, as users, what the credit analyst wants to see. And then you've got the third work stream, which is on non-financials, which is everybody else. And as we noted earlier, there's very different user types even within user and preparer types within corporates, chief risk officers, chief sustainability officers, CFO's office. Like all of those people need to be engaged, right? Because we all know at companies it's different, right? Sometimes the sustainability guy has some clout, sometimes he doesn't, many times he doesn't, or she. And so sometimes it's the chief risk officer. But we have, for example, one of our vice chairs is Graham Pithkady. He was the CFO of Unilever. And this guy's engaged, man. He's got his whole team involved. They are serious about this. So this is a relatively sizable army of people chunking this stuff out and reviewing all this content, documenting their review of the content. I mean, it's a nightmare. But it's very thorough, and we're not going to get everything, but we have a giant reading list of which many people are reading different pieces of it, and everybody's pushing back. I'll tell you, it's pretty impressive in a way, and I think we'll get a good product as a result.
Great. Oh, there's a question over there.
So I have a question looking forward, and it asks for a little bit of prognostication. Having lived in the DC area for 25 years and covered this stuff, this is obviously also, there's a political net aspect to this. Exxon's bet, and many in the energy industry, is that regulators will not act, or they won't act very quickly. If
Seems like
regulators
a fair bet, right?
don't act quickly, we're all kind of in a lot of trouble. But so the connection in the corporate world is this sort of political manipulation question. Companies do spend a lot, both before and after elections, and there's increasing attention to climate policy intervention in the CDP questionnaire.
Sure.
And companies have various types of disclosure. To what extent is your task force going to be looking at that question of sort of political involvement, or is it too hot to handle, and how are you going to handle that?
So I would say, it reminds me of what I always tell my team, in every politics is everywhere, right? I mean, I work at a big company, there's politics. It's like always be aware of the politics, never make your decision based on the politics, because that will just be a distraction. And, for those of you who do most of your work in the U.S., I mean, if I was going to be counting on policy, I wouldn't bother, right? The policy is just, I don't see it happening in the U.S. anytime soon, despite even if Hillary wins in a landslide. It's just too hard. The question is can you can create an environment in which that Goldilocks thing comes again. So if you're the SEC and everybody's using climate-related financial information in their investment decision-making, at some point you must actually step in with guidance, because you have to. You don't want to be too far behind. You definitely don't want to be too far ahead, because you will be slapped hard. But at some point, you're going to be too far behind. And in fact, you all may know this. The SEC just released a concept paper asking for information, of which 11 pages is based on sustainability-related data. It's all out there. So we are aware of it. We are told explicitly, particularly because we are an FSB-sanctioned group, and Saudi Arabia is on our, the FSB. I mean, there's just people here that are not interested in the policy side, and so we're steering clear of it. In that regard, you bring up a point, though, it's about adoption. Right? We can write the best guidelines of all time. It doesn't matter if nobody adopts it. So what do you do then? So even though this task force technically will be over in March of next year, I really don't see this. As a matter of fact, the Enhanced Disclosure Task Force started in 2010 with like a year and a half remit. They just closed up shop like 2 weeks ago. So, because one of the asks is to track our progress on adoption. So there's a whole sort of what are we doing post to make sure we get adoption. And it's not unlike what SASB is thinking about in different ways. I mean, first of all, it's multi-frontal assault. But what we really hope is to use Mike's clout and Carney's clout to get, and frankly, and I'll take some credit for this idea, we had all the task force members, we wrote to their CEOs and said, we expect your support, long and short. Now, they're not going to give their unwavering support before they see what the guidelines are, but the idea would be, and we're already sort of back-channeling with all these companies to say, will you pilot run this in your organization? So our hope is, you get the biggest free companies in the financials and non-financials in the different sectors to do this. The rest will follow. It'll be a long slog. But you can get there without regulation. You're right, it'll take longer. And it depends on how activated you all are. If we can really join together and get that done, I think with SASB and with the task force that there's a real chance to do something. There's a question about how much this impacts this idea that companies will do less in their sustainability reports, and I think that's a real issue. I'll speak for Bloomberg and say the sustainability reports serve a different purpose for us. They are a communication tool for vendors, employees, customers, the general public, all of that. I don't see that going away. I just see SASB and the task force stuff as a subset of that information that's used by a larger, more direct financial community and or regulators.
So, Curtis, you've touched upon the global aspect of the task force, and we've seen what SASB's been able to do and the challenges and hurdles that they've faced. It seems like as a global initiative, you're going to face a whole other set of hurdles, obviously, especially given the difference in the spectrum of the uptake in sustainability as a concept, forget even in action, across the world. And I've noticed a lot of people on the task force do tend to come from the West, either Europe or the US. How do you guys plan on addressing that and facing
Well, I mean, we do have representation. I mean, we've got the chief risk officer of ICBC, in China. We've got Japan. We've got the chief accountant for Tata. We have, and we're hoping to have someone join from South Africa. But that is a little bit of yes, there's a Western bias. There's going to be. It's because we have come from a culture of much more significant disclosure. It's just the reality of it. So it's a very good question. We are doing massive outreach. So we will be basically between July and Paris in September. We're traveling the world and doing events in Mumbai and Shanghai and Hong Kong and Sydney and Perth and Canada and all these places in Germany and Milan. It's going to be, unfortunately, not a very restful summer for many of us. And we're doing it in a way that we don't catch the Europeans on vacation, because obviously South America, it's their winter in August, so we can do that. So we're doing massive outreach on a just general basis, kind of like this, but we're also doing very targeted focus groups. So once we develop these sector-specific recommendations, we're going into Safe Place and getting users and preparers in a room, first together, then separate. All of this is being done in real time too, so I reserve the right to change all of it. But very focused users as well as just general outreach. There'll be a whole meeting. There's just a giant communications plan that we know is needed to make this successful, and there is a Western bias towards it. It's just by nature of the FSB and who was submitted. Saudi Arabia didn't submit anyone, so there's no one on the task force. But it's a great question, and it's a big challenge. And I don't think just to point out SASB, people are like, well, people aren't using the SASB standard. I'm like, they just finished their draft provisional standards. They haven't even done the finalization yet. So I think the timing is good. You can use both to kind of accelerate each other. So, yeah.
Great. And Alice, sorry, in the front row.
Based on that question, and getting back to SASB, you mentioned overlap of looking at their process and trying to have a similar process, or at least learn from their process. But I guess I'm wondering, obviously on some of their disclosures for industries, there's our environmental disclosures they're looking for. So and I hear companies complaining about all the different things they're being asked to do, and you wanting to make this acceptable to many companies. So will there be some overlap in actual disclosure from the environmental piece on SASB and the
Yes, absolutely. I mean, the only reason you can do this in a year, is because of all that work that's been done. There will not be, let me be clear, we are not creating a new standard. Full stop, period. We are looking across the landscape and saying, just like SASB does in their recommendation, if you look at their recommendations, they have their, I can't remember what they call it, the tying in document where it says, we want GHG, and they're like, reference CDP, GRI, GHG inventory protocol. We'll do the same thing. The goal is not to create too much that's new. I think what will be new is likely to be new is us trying to figure out this scenario analysis bit. And that's an important thing. It's really like a value at risk over a near, medium, and long term. And how do you do that? I don't think we're going to come up with the answer. But that'll be the sort of, it's not even that innovative. People have been talking about it, but nobody knows how to do it. So that's really where we're going to go. I know that you've had your hand up.
Yeah, I was going to say, Cynthia.
Sorry, Cynthia Simon, CDP. So I would imagine you're going to get pushback from financial institutions,
you think?
banks, and asset managers, because the only way you're going to have to really look under the covers here if they're going to be implementing this, because the Scope 3, and that's the key piece that's missing. Mm-hmm. So from what you're saying, they've gone into this with eyes wide open, and
and there will be. I expect most of that fight will be between the July plenary and the September plenary. There's going to be pushback. There just is. Let me assure you, it's not just the banks. The companies don't want to do it either, and so it's just finding that right amount. And Scope 3 stuff is interesting. It's for them. If you're talking about financed emissions, I mean that's a hot thing. So which part? It's going to be. Keep in mind there are ways to thread the needle on this, right? There's sort of here are the guidelines, and they're ambitious, but then there's the how do you actually do this? And because they're voluntary, they don't have to do it all. We're going to try to get them. We want to show best practices. And they will push back and say there are things we can control and things we can't. And that may or may not be a legitimate argument. We have not admittedly had the real blowout argument on that yet. That's within the financial work streams. We're hoping kind of like a committee that they'll sort of sort some of that out amongst themselves and bring it to the full task force. Might be wishful thinking. But I think the key for us is getting that baseline concept stuff right, because it gets easier after you do that, because then you have a construct. And it really is about personalities and internal politics and allowing people to get where they need to go. If you're the rep from the oil and gas industry on the task force, even if you're the biggest environmentalist on the planet Earth, everybody in your industry is looking at you, man. So they need to be able to, you need to provide them the support to defend the position that comes out of this task force that may be a challenge for them. And so you got to help them get there. And that's just a lot of it. And a lot of that's happening now. The big fights, frankly, haven't happened yet. That's the bottom line.
I think Andreas had a question, and then we'll go with Steve, and then Andreas, if that's right, Andreas. Oh, we're going to go with Steve, sorry, just because he didn't have the mic.
Okay, sorry.
Because he didn't get to stand up on stage.
Yeah, exactly.
Not yet. Steve Godeke, just like this, I understand like the sausage making aspect of this, but is there, and I haven't been as involved in this as you all have, but is there an aspect here of like that the asset owners are represented, and because a lot of this is driven by like, okay, asset owners are pushing this through the system. Sure. Is that how it's working? And does it sit, I mean, not in a purely linear way. I know there's all kinds of things, but what's the role of the asset owners versus all the intermediaries, the financials,
all of those folks are in scope. They're also going to be asked to report. I mean, so PGGM, and I can never get the Canadian ones, it's too long, CPIPPB or whatever.
CPI maybe.
They are on the task force. And then you've got hybrid asset owners like Aviva, Steve Waygood, they are insurance, asset management. Because they're insurance, they're asset owners. I mean, that's the other thing that you point out is I think people outside of the financial system think of the financial players as some monolithic beast. Well, boy, no. Identifying the different user types and their needs has been a real challenge. We're not done with that. There's credit analysts, there's risk officers, there's all of that. But they're all in scope. The intermediaries are a big one, because technically if you were to say, I want people to disclose and it's got to be in the financial filings, intermediaries don't really have financial filings unless they're huge and have some public debt, maybe, I don't know. So how do you capture that? What's the mechanism from which they do that? These are all discussions that are happening right now. But it is, if you look closely at the task force membership, you'll see that all the people within that chain are represented. And as I always like to joke, the asset owners, it is the golden rule, which is he with the gold rules. And so if they can really get behind it, but I think those of you, and no offense to any asset owners in the room, there's trustees too, by the way, or considered part of that, is that I got a lot of bark and not as much bite, in my personal opinion. And so this is a way to activate them. It does tie in with some other things they're doing, like this long-termism project that, that Mark Wiseman and Dominic Barton from McKinsey are sort of spearheading. Larry Fink's gotten very far behind. He came out with this letter to the S&P 500, actually mentioned the term ESG. We're all like, yay! He knows what it is. So yeah, you're hitting all the stuff. It's a beast. But people think that if you do not address every link within that system, that just one missing piece could just kind of collapse the train. And so that's a big point of discussion.
Andreas,
you have dozens of very interesting indicators on Bloomberg itself, on climate change, climate governance. People talk about risk, quantitative, qualitative. Could you just take these indicators, like which companies report and which don't, 1-0, and then run them against cost of equity, cost of debt to figure out what is material? I mean, you're really sitting in front of the treasure.
I mean, that is not, yes, that's helpful, and we've done some work on that. But it's been very high level. The idea is we don't want to outsource the expertise that we have in the room. Part of what I said earlier is that we need to bring these people along, and some of that is by showing evidence. But the indicators, as you well know, it depends on what the outcome is. If you're trying to look at potential systemic risk, which many people argue, and it's a fair argument that they don't think there is any, versus the overall need to look across the portfolio, still people don't report emissions the same way. I mean, this is a little bit about that, right? Making sure that your boundaries are appropriate. And then how do you capture the opportunity side? So my favorite example is GE. GE just this year, for the first time ever, started disclosing their solar and wind business. I mean, let me be clear, this is a massive business, multi-billion-dollar business, but it was not technically material to them because they're so massive. So they never disclosed their revenue on that, on those businesses. And the idea is that if you want to really understand the resiliency in your portfolio of a potential swift shift in asset pricing, you also want to understand the resiliency of the firms in which you're invested to make that transition. So you could argue that GE is actually pretty well positioned. They've been getting killed in their oil and gas services business, but their solar and wind businesses have been doing quite well. I would like to know that as a portfolio manager long before they just finally disclose it to me. I mean, on the Bloomberg right now, it just says NA. It says it says solar and wind. Well, now it says it has numbers, but before that, it just said they're involved in that business, but I don't know to what degree, so I can't measure how resilient they will be. And if I can't do it for them, I can't do it for the rest of my holdings. I have no visibility.
May I just quickly,
Yeah.
the fact that it's an A or not an A, that itself is a very interesting indicator, isn't it?
Yeah.
And you have so many indicators, and everyone,
We're
not
not going to
everyone will be
outsource
filled.
it to statistical review, Andreas, sorry. As much as you'd like to. It's very important in supporting what we're trying to achieve, yes. But I think you would agree that the indicators are just all over the place. There's no consistency. And there's a
Except for the
disclosure
NA.
bias. There's
I think
a
the
disclosure
NA is the
bias,
consistency.
which is what you've seen. There's a disclosure bias.
Yeah.
Generally speaking, what he's talking about, and I think he said this earlier, is that if you have decent, it's kind of that another Bloomberg, you manage what you measure. People who are disclosing are generally disclosing because they're doing stuff. And therefore, and there's a size bias and all of that. But it's just, it's an important part of it. And I would love it if you would do some work on the sides with this, for free, of course.
The consistency of your analyst for the
Andreas,
NA.
I'm going to
Sorry,
cut you
okay.
off. Yeah, sorry, because lunch. I think everybody's quite ready to break for lunch in a minute.
Yeah.
But I'll let you guys follow up. Curtis, I just wanted to end on one question. I noticed two different things that you were talking about. One is that you've been able to bring the whole chain together to have this conversation, which oftentimes when you have that many players, what you end up with is the lowest common denominator scenario.
Talk about that.
But you've also mentioned that you feel like this group is going to push the envelope a little bit on some of the concept around materiality. So I think in ending, it'd be really interesting to understand, what do you think is driving all of these players to come to the table, to agree, and driving this outcome overall?
Yeah, no, I mean, look, the irony is this is the kind of thing that Mike Bloomberg hates because it's ruled by committee. But it's not. We do need to, it's a very good question, because we do need to have some level of consensus. But there's a question about what, how are you going to get this, a diverse group, this lowest common denominator risk is real. So a lot of this, frankly, is going to be some backdoor channeling with different constituents that are difficult, and saying, don't fight us on things that are editorial in basis. Fight us on things that really matter, right? And how? It's a really good question. We do not know the answer yet. Is there a possible scenario where we kind of get everybody there except a couple, and then does that mean we're dead, or do they abstain from the report? How does that work? The problem, if you don't get it, then you don't get this. You gotta love bureaucracy. You don't get the FSB welcoming your report. You could get the FSB receives your report, which is basically like, thanks, but we're not loving it. And then you get the G20 won't even take it. So the G20 in our phase 1 report, the FSB welcomed it, but the G20 received it. They weren't 100%, behind all this stuff. So we don't know how we're going to deal with that. I will say that the real way we get it done is Mike and Mark. These guys are influential, and they're friends with the CEOs of all. You've got Paul Pullman on there. You got, Larry Fink. You got the CEOs of the companies represented. Have shown leadership in this area and are also behemoths. And it would be, we've kind of put them in a bit of a spot, I'd like to say. They're going to have to really get behind this in some way. And so we're terrified of that. That's why we say ambitious but practical. That's sort of our motto. We need to get it done. Great question.
Well, thanks so much, Curtis. I think appreciate you taking the time.
Yeah. Thank you all.
Lunch is being served outside of the room, so we can all take a break. Stretch, we will be back in about an hour.
How are you doing?